Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, February 28th, last day of February 2025. This week gave you everything you could want. Rips higher, dips lower, different sectors trading well, other sectors trading poorly. What do we take out of this week? It had been a continued kind of drip lower that got some acceleration midweek. As far as our portfolios go, we have a couple of rules we try to respect in downtrending, even short-term downtrending markets. And one of those is we want to see a weak open followed by a strong close. You got that today on Friday. We had held off on those strong opens that would dissipate through the day and close red. Strong opens, weak close are a difficult market to trade into, to put cash to work. So what we were waiting on, I was talking to Charles on our trading desk yesterday, we were looking at a few different names we'd like to add to the portfolio. I said I'd love to see a weak open Friday morning and a strong close. That's a better platform to trade off of. So we got that today. That's a positive. In terms of what's working, tech has been weak, but really in line with some of the pullbacks we saw last August, saw last spring. When you have areas, large cap growth and tech and consumer discretionary that rip higher, they have to consolidate. And they'll use absolutely any excuse to consolidate. So we can talk about tariffs. We can talk about the data centers getting ahead of themselves and Microsoft cutting back perhaps on some of their data center work. We can talk about multiple reasons for why large cap growth and tech in particular has had some weakness the last 2 or 3 weeks. They were looking for an excuse to consolidate some of that strength. Does that mean they go back higher here? Maybe not. Maybe they need to continue consolidating. But I mention that because everybody looks for one reason. It's never one reason. We always talk about the markets being a large puzzle with hundreds of pieces. And if tariffs are one piece, on the other side, so is the fact that AI can drive incredible efficiencies over the next decade. They play off each other and markets find a reasonable price to execute at. And that's where we are now. We had good news and bad news in portfolios this week. How about Berkshire Hathaway? That's been a long time holding in tactical trend. That's been our largest individual stock holding. Rips to all-time highs. Everybody all of a sudden loved the fact that Warren Buffett has raised a whole bunch of cash looking for some reasonable deals down the road. That and very solid earnings out of their insurance unit last weekend. So that was a real plant to flag type of security in our tactical portfolio. Where are we hurting? Well, in tactical, we're hurting in some of those data center plays. GE Vernova stock we bought, 160, 170 less than a year ago, ripped up through 400. We sold some at 400. Today it's going to probably close around 335, 340. There's some weakness during the week. They trailed along with tech. So keep an eye on tech. Where else do we throw some little lobs at? Remember last week I mentioned we bought LRCX, Lam Research, last Friday. That was a semiconductor name pulled down into an area that has shown really good demand and support over the last, call it 5-6 months. Pulled down there again. I was hoping we could make a little higher high, higher low versus that previous trip. We're sitting right back where it's found support in the past. We'll find out if it finds support now. That's why I always talk about potential support. It's never support until the stock moves back higher. I hear support and resistance until my head spins. It's potential support, potential resistance. So again, U.S. core, very steady. That's a diverse portfolio. Remember when large cap growth was all the rage, U.S. core, US ETF had difficulty keeping up because it's a diversified approach to the equity markets. Now we take a look at some of those holdings like the banks and the financials. They're really adding some nice support to those strategies. So solid. International continues to surprise me to the upside. Again, we don't want to be surprised positively or negatively. We want to listen to what the market's telling us. Right now it's saying that perhaps Europe did find a valuation that made sense. Remember, it's trailed the US by multiples over the last decade. Rightfully so. Their growth is anemic. But maybe that weak growth finally found a price where it makes sense to own it. So international has been solid. Again, let's not look at equities in a silo. What do we have on the bond side? And John will be with you in a moment talking about bonds. We've been fairly consistent. Go back to our weekly videos that we feel bonds are kind of range bound. And when the 10-year Treasury starts getting to 465, 470, 480, we'd like to be a buyer there. We continue to be buyers there, both in the taxable account and in the muni account, the muni strategy. Now we're all the way down to below 4.25 on the 10-year. That's supportive of bonds. That's supportive of equities. So, a lot of volatility. Hopefully that volatility continues for a little bit more. Volatility creates opportunity. We'd like to see some more opportunity in mispriced securities. That's what we're always looking for. People mention value. Value is an overused word. What we're looking for is mispriced securities, whether they're in bonds, whether they're in individual equities, or whether they're in ETFs. So as promised, the Moose is next. Enjoy your weekend. Keep your hard hat on. I'm sure next week we'll have plenty of surprises.
Hi, it's John Musso. I'm the Director of Fixed Income at Cumberland Advisors. It is Friday morning on February 28th, last day of the month. We are in San Diego. We've been out here at a conference and also seeing some clients. This week, big week in bonds, yields down across the board on treasuries, 20 basis points, 10-year bond at a 424, 2-year bond at around a 402. They're down about 20. AAA muni scales, those are down about 2/3 of that, so you're at a 286 on a AAA. This is a guesstimate. In the 10-year, and probably somewhere around a 252 on a 2-year bond. As we know, muni yields don't move nearly as much as treasuries when you have this kind of volatility that you've seen. What's been the drivers? Continuing soft data this week. Whether you want to take the Philadelphia Fed non-manufacturing index down a lot, pending home sales down a lot, initial jobless claims higher than expected. Today, good number on inflation, PCE at 0.3 for the month. That is the Fed's favorite measure of inflation, as we know, and the fact that that was right on expectations. The year-over-year number 2.6, that's the lowest number since early in 21. That is good news for the Fed. As we know, the Fed has said they are on hold, cutting short-term rates until they see more evidence of inflation. Certainly of inflation coming down. Certainly, some of the numbers that we've seen out there would suggest that people are pulling back a little bit. It certainly seems like the stock market has caught a cold. My colleague Matt talked about that, and I think, when you look at things, our outlook has been right along that the fear of Trump was worse than Trump. You can tell that from the drop in yields. 480 going in a week before the inauguration. Here you are at a 424 now. That has been a combination, I think, of people recognizing what the administration is doing, the fact that they are now laying off lots of government workers. Those people are not on the rolls yet. They will be. So all of this is feeding into the idea that things are softening up a little bit as we go forward. We'll have more news for you next week when we'll have the employment report. We hope everyone has a great weekend. Thanks a lot.
Thanks, Moose. Have a great weekend.